Hey, what's up, everybody? Welcome to episode number 142 here on season 1. And today we are talking about what is a stop loss. So, the reason why this topic is so important is early on in my days of trading, I was against setting a stop loss. I always felt that setting a stop loss was almost like betting against myself to lose. It was like betting on myself to lose, or expecting to lose. And I think that this had a lot to do with my college days, where I studied psychology and placebo and self-fulfilling prophecy and expectations. And my line of thought was basically like, if I set a stop loss, then I expect the price of that stock to drop. And it was basically like I'm expecting to lose. I'm expecting a loss, obviously. And so that train of thought was always how it was before I read a few books and was able to develop a better understanding on why a stop loss is actually important, and it's not actually betting against betting a loss. It's actually helping you win. And so within the past few years, I've instituted using a stop loss, and it's definitely helped out quite a bit, especially minimizing my losses. There's been a few trades, and I talk about some of those with like TRX, which is down, I think, to 27 cents right now. I originally was buying it at like $1.50. So, that one, I didn't have a stop loss on it, and obviously it drained half my account almost, or half of the money that was invested in there. It's already dropped. It's already lost about half of that. So the importance of setting a stop loss definitely helps minimize your downside while protecting basically your upside. So anyways, what is a stop loss? A stop loss is a trade or an order that's proactive. It's a proactive kind of trading. It's like basically it's an order that you put in that says basically if the price, so you get into a trade and they say if the price drops to this level, then convert that at that level, convert that to a market order and dish the stock basically. So in essence, if a stock was to drop down to a certain level, boom, it hits there, converts to a market order, sells immediately, and you get out of the trade. So it's a very easy way to definitely protect a lot of your assets, and while still minimizing the downside. Basically, an example of this would be if you were to buy Apple stock, which today was closed at $169.4. So say you bought it at $1 or $169, and then you were only willing to lose, or the risk that, however you figure out what you can lose on that stock. Say it was $5, so you're going to set a stop loss for $1 or $164 basically, so $5 below what you got in at. The next day, Apple stock opens up strong, boom, we get a nice run, and the next thing you know, bad news, whatever it is, starts coming out, and boom, it starts dropping, and by the close of the day, it drops down to 160. Well, thankfully, you had set your stop loss at 164. So as Apple stock starts dropping, hits 165, 164.5, boom, 164. It'll convert that into a market order. So it should sell your shares around that price of $164. It's not exactly, because it's not a limit order. It's a market. It converts it to a market order, which sells immediately to the person that is within right in that range. And then from there, preserving your profits or preserving your assets, and keeping it from decreasing all the way down another $4. So instead of losing $9, you only lost $5. So like I had already said, setting a stop loss, using stop loss is a great way to limit loss. Limit your losses on a stock. The only thing with setting a stop loss is if earnings, which we've been having a lot of earnings come out, is that stop losses, if you're not in after hours, then you can't have stop losses in the after hours. So if you hold it overnight, you could wake up and have a gap down or a gap up, and so you have to understand that holding a stock from one day to the next day, especially over earnings. You could see a huge gap down. Like one stock I was in, I think, came out with earnings today. It was stock DDDDD or triple D. It dropped. I think I'm down on that 10%. Earnings call was terrible and it dropped. So tomorrow I'll probably get out in the morning. We'll see what exactly how the market looks on the open tomorrow. But that's like from day to day, like, yeah, it's going to definitely help limit your downside when the market's open. But as far as it goes from day to day, you can't really help that. That's kind of the risk of being in a swing trade or a long-term investment kind of style. And then also it helps increase your upside because you're not losing as much money on a drop. So even if it was to drop to 160, boom, and you got back in at 160 and you had another run up, like that would be pretty good. It ran back up to 160 and like you made $9, but you would have lost $5, so you made $4 back. So there's definitely an importance in setting that stop loss and making sure that your assets are properly protected. That way, when you do have a run up on a stock, you can make money and you're not using those run-ups to help cover the losses that you've already took by making those investments without setting a stop loss. So anyways, let's go ahead and dive into the question of the day, and that is, how many times could you fit Toronto into New York? And honestly, I have no clue what the size of New York is versus the size of Toronto, but I would have to say about 3 times. Anyways, if I'm completely wrong, let me know in the comments. If any of you guys want to research that, I don't have time to, and I don't really honestly care, but that's the random question, and hey, somebody wants to know. Anyways, if you guys have any questions regarding Stash, Acorns, or Robinhood, as well as general investing advice, business, Etsy, or coaching, feel free to check those out. Post them down below. Post the questions down below. And until next time, don't forget to subscribe up in this corner and check out Keeping It 100. And then check out this other video right here. And as always, thank you for watching. I really appreciate it.